Friends, in this video for I Thought Wealth, I'm going to talk to you about reinvestment risk and our thinking. When I asked friends why they are holding on to a company when it has done everything it can do for them and it probably won't do much for a reasonably long period of time going forward, the first answer or first line of defense would be, what will I buy if I sell? The lack of investment opportunities to put the money in is something that bothers them because they have had a hugely successful investment, and where they should put their money, which they take out from a hugely successful investment, bothers them. In that sense, I actually recognize and respect that, because they are conscious of the fact that their money should move from one stock to another stock only if both the stocks are respectable and the second stock has the ability or the capacity to deliver performance reasonably comparable to the first stock. So that is the whole idea behind their thought process. I really respect this thought process. The next point which people come up with is, I don't want to stop a good thing, I want to keep a good thing going, right? So when you ask them, when will you bring it to a halt or when will you put a stop to it, the typical response would be, I let it run as long as it lasts. Let the good thing keep going. And they think that they will actually change it before it's too late. Extremely smart investors are capable of doing this, I have no doubt about it. But investors in their first cycle, those who don't have that experience, generally are not able to bring themselves to do that reinvestment, and they tend to hold the stock all the way up and all the way down. So reinvestment risk is real, but we need to find investments that will succeed our successful investments. Your super successes need to still have successes, and it takes a lot of time to find those successes. So how can you manage this? How can you do a good job of it? In my view, when you have a great idea, start thinking of which idea can succeed that idea. Then your whole thought process is oriented towards finding a stock which is of the same pedigree or a better pedigree. Where people make a mistake is that they simply identify something and think that because they have identified it, it will still be of the same pedigree. I have also done it many times, but this is something that we have to learn through our own practice. It is not something which can come very easily. So selling a HDFC bank and then going and buying a Bandhan bank, it happens. Similarly, we make mistakes in small and mid cap space. So that reinvestment risk is something that is there in the lives of everybody. The only solution is to prepare better. It's to keep thinking which company can succeed such a good company. If we do that, we will find that good company at least in some other sector. Where reinvestment risk becomes a real risk is when you try to find that company within the same sector. I mentioned HDFC and Bandhan only for that reason. So people sold the private banks, the hugely successful, respected private banks, and then went into microfinance, right? That is a problem, because within the same sector, it's very rare for you to find answers to reinvestment risk. That reinvestment risk actually plays exactly the way we fear it will pay out. So that is something that we should not do unless there is a very, very strong compelling case. So trying to find the replacements for a great success stock should be outside our existing area of success. That naturally will take time. If you are an investor who has done very well in chemicals, you have to go to a new sector and try to find a great company. It is going to take time. So give yourself time. Be ready to keep your money idle for some period of time. Don't let reinvestment risk rush you. Don't let it bother you. Don't rush your conviction. Don't make hasty decisions. Allow yourself the time to come to that point where you say, yes, I'm sure this stock is a worthy successor to that successful stock. But the investment action you need to make on a successful stock cannot wait. It has to be made when the stock is seeing unprecedented euphoria, when there is complete consensus, when nobody wants to be a contrarian, valuations look very, very stretched, and you know that this stock is going to see an extremely long time correction even if these fundamentals sustain. Those who did this in 2000 in tech, those who did this in 2008 in infra, those who have done it in 2021 in pharma will all be respected for their ability to walk out of a winning team before it's too late, understanding that the party has gone for too long and leaving that party before things turn nasty. It is very critical for those who have left a party not to rush into another party in the neighborhood. You need to go home, take some rest, pick yourself up, get your ideas together, and then decide where you want to party next. After a great party, give yourself some time to rejuvenate before you go to the next party. Managing reinvestment risk is never easy. It calls for a lot of preparation. It calls for preparation to sell out of a great success. It calls for preparation to stay in cash. It calls for preparation and research to identify the successes, preparation to build your conviction, and then call yourself to sustained investment action. So there are number of parts, number of moving parts in this, and you need to manage reinvestment risk sensibly right through the process. Reinvestment risk must not stop us from doing whatever it takes to protect success, to safeguard our winnings, to keep money ready for the next idea, to prepare for the next success, and to move towards the next success. We need to handle all these parts sensibly, and I'm sure that all of you are going to do it in the future. I wish you well in the way you're going to manage your reinvestment risk, because that is going to be critical for your growth and evolution in the coming years. Thank you for watching this video.